Hi guys, what's up? I hope everybody is doing good and welcome back to another episode of the stock market series as part of the Wednesday Wisdom initiative. In today's episode, I have something really interesting for you because in this country, fixed deposits have been one of the traditional investments of every household. But I'm going to show you with some examples, of course. If you have invested the same amount of money that you have invested in fixed deposits in the same bank's stock, how are the returns going to be? It's a very interesting comparison, and of course as part of this video you will also learn a couple of new concepts, so look forward to that. I have a special request for you for this video because a lot of elders, your parents, may be interested in investing in fixed deposits, and maybe they have been investing in fixed deposits till now. So I request you guys to share this video with all of them so that this kind of an outlook can be shared with them, and who knows, maybe they might get interested in stock markets. Now, as I usually tell, one thing that is the prerequisite for being in stock markets is patience. So I have taken a 5-year time horizon for understanding this example very clearly. So let's get into the video and understand how over a 5-year time horizon investing in banks fixed deposits versus investing in the same bank stock span up. Let's get started. Now, before I begin, here is an interesting fact check that is coming up, which I've shared in my first episode of the stock market series, which goes by saying that if you want higher returns, you got to take a higher risk, and if you are taking a lower risk, you will end up getting a lower return. I thought I should make this clear in the beginning of this video because bank FDs have a stable return, and since you are taking a very low risk, you will get a very limited return. But then when you invest the same money in the bank stock, the risk levels obviously go up, and so there is a potential for you to get higher returns. So let's start by understanding what is a fixed deposit. Of course, I hope all of you know this, that you park a certain amount of money in the bank for a fixed period, and as you see there, it's also available with NBFCs in the likes of Muthoot Finance, Manappuram Finance, Shriram, and other places. So if you're parking a certain sum of money for a fixed period, maybe 1 year, 2 years, 3 years, 5 years, depending on whatever the time horizon is, that is called as a fixed deposit. So what are you going to get in return for parking your money in a fixed deposit? The return is in the form of interest, as you see there. I've taken the example of an investment of rupees 5 lakhs, which I'm going to keep constant throughout the video so that our comparisons become a little more easier. So if I have funds of rupees 5 lakhs which are ready to be invested, I can obviously put that money in a fixed deposit, which fetch me a 6% per annum return, which will be 30,000 for the first year. Now, also there is an assumption that whatever interest I earn in the first year will also be reinvested or renewed as part of a fixed deposit, and that's how our schedule goes. And this part of 6% is called an absolute return. Now, why is this term absolute return important will be explained very shortly, but before that, let's take a quick view on what's going to happen with our 5 lakhs. So if you have invested 5 lakhs into a bank FD on the 1st of April 2017, carrying a 7% interest, which was the normal bank interest at that point of time, you would have got 35,000 interest per annum. And we are assuming that you're going to invest that 35,000 again back in the FD without withdrawing. So the current value of the FD will become 5,35,000, which gets reinvested, and that happens for 5 years. And at the end of 5 years, you will have a fixed deposit whose worth is 6,88,244. Started with 5 lakhs, ending with 6,88,244, making you a return of 1,88,244. Over a period of time, you have earned 7% interest for few years, 6.5 for few years, and maybe the interest rates have dropped below 6, but I have taken 6 even in 2021. Stable return that you have earned for each year is very clear from there, but what is the compounded annual growth is also something that we have to see, because absolute return can be misleading. Because absolute return is a return that you make for that particular year. But when you are comparing two things, it could be very, very misleading. So right now I'm going to introduce a new concept to you, which is called as the CAGR, which many of you might have heard in different contexts, generally used for stocks, saying that the stock has a CAGR of so much. And a higher CAGR indicates that you have made a lot of return. So what is CAGR actually? The compounded annual growth rate will take into consideration one of the most important factors which absolute return doesn't do, is the time factor. Absolute return is calculated based on what is the initial investment, what you got towards the end. And as we go in the previous slide, you've seen that 1,88,000 was your total return for a 5-year period. But when you want to actually factor in the time, what was the stable return that you earned over a period, that's when compounded annual growth comes into picture. I'll also show you with an example as to how CAGR is computed. Is something very interesting for you to understand, because many people ignore the time factor. So if you want to calculate CAGR, a big formula here is CAGR is nothing but the value at the end, that is the terminal value, divided by the beginning value to the power of 1 by time minus 1. Now that's a mathematical formula out there. Simply you got to apply those two values. That is, in our example, if you go by computing the CAGR for this particular example where you have earned 1,88,000, you would start with 5 lakhs, you would end with 6,88,244, and you've made a return of 188,244. And applying the formula that you saw, that my terminal value 688,244 divided by 5 lakhs to the power of 1 by 5, because 5 is the time horizon that we have taken, minus 1 gives me 7% compounded annual growth rate. So if somebody has asked you how much have you earned over 5 years, you can straight away go and say that it is 7% per annum. Now this is what an FD gives you over a period of 5 years, a CAGR of 7%. Now I'm going to keep this example constant throughout the video from the point of view of the FD. And then let's bring in respective banks and see if we have put the same 5 lakhs into the bank stocks as on April 2017, what would their value be today and how much would the CAGR be? And that's going to be interesting comparison for you, so that you can make a call if you want to go for FDs or you want to take a leap into the stock markets and see what is it going to be. Now I'm going to take an example of ICICI Bank, and if you have put the 5 lakhs in ICICI Bank as fixed deposit, you will end up earning a 7% CAGR over a period of 5 years, and you would have earned a return of 1,88,000 odd. That is something that you've already seen. But let's make this scenario a little more interesting by seeing how much of ICICI stock you could have purchased. So amount available for investment continues to remain at 5 lakhs, and market value as on 3rd of April 2017, that's because that is the first trading day in 2017. The value of ICICI Bank stock per share is 261 rupees. Now going by that, you would be able to buy 1919, that is around 1900 shares of ICICI Bank with this 5 lakh rupees instead of putting it in an FD. And I've already told you, when you buy a stock, you have two ways of making a return. One is the dividend income that you earn every year if the company has declared it. Two is the capital gain that you make at the end of 5 years. You may end up even making a capital loss. I do have some interesting examples coming up on that note as well. So let's see how did it span up for ICICI Bank. Wow, that's a great looking chart down there. So with 1919 shares, you've started on 3rd of April 2017, and on 1st of April 2021, with the same 1919 shares, you have a value of 11,40,654 with a return of 6,40,466. This is only on the stock part. Maybe the dividend is not very attractive, but still you have earned a 1,574 rupee dividend. Now let's look at how the CAGR spans here. Wow. So you've initially invested around 5 lakhs, and that value at the end of 5 years has become 1140, which gave you a return of 6.4 lakhs plus a return of 1574 on dividends, and a total return on investment of 6,42,000 with a CAGR. I hope you guys now know how CAGR is computed, because I apply the same formula. This is the value at the end of 5 years divided by my initial value to the power of 1 by 5 minus 1 gives me 18%. You can try it out on your own as well. So CAGR of 18% versus the CAGR of 7% that the FD gave me. Now, will every bank scenario look this attractive is also something that we have to see. So I'm bringing in more examples. Now to continue, I'm taking HDFC Bank, another well-established bank in India with a lot of customer base. So let's see how this pans up. And same example, so you're taking 5 lakhs and as on 3rd of April 2017, per share value of 717. So you would be able to buy only 698 shares of HDFC Bank. But then let's see how it spans up because the share value is higher. Okay, you started with an amount of investment of 5 lakh rupees and not bad. You ended up with 10 lakh 37,752 because the stock value as on 1st of April 2021 is 1486. Now, mind you, there has been a lot of ups and downs during the 2020 pandemic period and the stock has really taken beating. So this example is after a great recovery, and also as on 2021 there are talks about the second COVID wave and the stock is still taking a beating. Bank Nifty not doing so well. At this point of time, with a price of 1486, it looks really attractive because it made a return of 5,37,000 odd with a very meager dividend of 412. But that's okay to have a lesser dividend in this case because you still are making somewhere close to 5,38,000. Now let's look at the CAGR for this particular stock with an initial investment of 5 lakhs and a terminal value of 10 lakhs. You ended up making a total return of almost 5,38,000 with a CAGR of 16, slightly lesser than the ICICI Bank CAGR, but with 16% compared to the 7% CAGR on the FDs is still a very attractive option. I do understand what's going on in your mind, whether every bank will give this sort of a return. No. So what I'm doing here is to compare some of the leading banks and let's see how things shape up. Now that you know how I computed this table and how we are computing CAGR, let's look at this scenario. So you've detailedly seen ICICI and HDFC. I've also done similar kind of work for Kotak and Axis and just presenting you the final summary. An investment of 5 lakhs initially in Kotak would also be almost equal to the money that you had in HDFC, so which is around 10 lakh 30. So also giving you a CAGR of 16%. So this are the top 3 very attractive options that you would have had if you had put your money in 2017. 18%, 16% and 16%. But will this happen with every bank? No, that is exactly why I've picked up more examples. And if you see on your screen on the Axis Bank, if you have put the same 5 lakhs into it, it would have just given you 2,13,000 rupees, which is slightly better than the 1,88,000 that you had on your FD, also giving you almost a 7% CAGR. Now, this may not be something that's really attractive. So, herein I would like to mention that if you are really making use of this kind of a video to understand how things work, you might have to get down in little more detail and do your personal analysis. Honestly suggest that you take help of professionals who could do this for you and suggest you proper investments. So that is the scenario with these 4 very well-known banks in India. But of course, if you put money into some other banks other than these, let's see how that would have spanned up, because I'm now going to show you an example that's going to scare you a little bit. Because if you are excited till now in this video, now is the time where I also tell you the other side of what markets can do to your money. So let me show you a very interesting theory about the S Bank. We're doing the same exercise with the S Bank stock. With my 5 lakhs with a price of 308 per share, I would be able to buy 1625 units of the S Bank stock, and it would have given me this, and that's not a very attractive thing to see on screen. With a price of 308 rupees, you've invested 5 lakhs into S Bank. Today, as of this date on 1/4/2021, the value is 25,513. Now, you've earned a dividend of 1885, but who really cares when something like this has happened? Complete wealth erosion. Now, if you look at this very carefully, this stock, of course, had problems. There's a lot of insight in the news. So even if you have made a wrong investment, you should have known your exit point. And that is why I tell you, entry and exit points are very important in stock markets. And when you think something is not going in your favor, you should consult an expert and try to get out of the market. If somebody has waited for a couple of years and then they've seen like, okay, this is not moving anywhere, maybe they should have exited with a mere loss, but they would have exited. Maybe if you've given yourself one more year, okay, slightly bigger loss at 49,000 or 50,000 odd, that's 10% of your investment is washed off. But still, the rest 90% of the capital is at least safe. But just imagine if you waited one more year and then the stock has really taken a beating during the pandemic, and of course a lot of issues it has gone through, and it's not a very good story to listen. Even today, if somebody is holding Yes Bank shares, I guess there is a 3-year lock-in period for their sale. So this share is really a bad investment. The stock has taken a real beating, and nobody would definitely want this to happen with their money. If you remember the fact that I told you in the beginning of this video, if you are expecting 18%, 20% CAGRs, you would also take a risk of that size. So if you don't want to take that risk, stick to your FD. But like I said, don't get scared. You just have to consult an expert, understand things, look for the right bank, check their financials. Now next week, I'm going to introduce my video on fundamental analysis, which will help you analyze the financial statements more deeply. So do all that and then take a call. Am I going to close my video right now? No, I'm going to show you one more terrible story. But before which, we're going to look at the CAGR of Yes Bank, not looking very attractive. A 45% negative CAGR, you've lost all your money, and I don't think that's a good sight for any investor. And that too, who's willing to invest money in the long term. There comes the terrible story of Lakshmi Vilas Bank. Trading of Lakshmi Vilas Bank stock is now suspended with effect from 25th of November 2020, because after that it has been merged with the Development Bank of Singapore, the DBS. It was RBI's decision to do that, and there is a lot of panic, things not working well for LBB, and the shareholders still have an appeal held up in the Supreme Court that their share values should not be brought down to zero or trading should not be suspended. But the terminal value of the share, I think, got closed somewhere around 7 rupees. That was the last trading day's value. Equity shareholders are the ultimate risk takers, and in this case, it got really proved. So if you've invested 5 lakh rupees in LVB in the year 2017, you will be able to buy roughly around 3,200 stock on 1/4/2021. It's not at all attractive because it's not even trading, because as of 25th November 2020, if I'm correct on that date, the trading was suspended. No dividends in the last 4 years, and you've received only dividend in the first year. Now at this point of time, if you see the dividend when compared to the others, this bank has given you a very, very attractive dividend which no bank has given. So it was a really good performing bank, and when this happens, if you are alert as an investor and if you see that things are not going the right way again, you would have taken an exit here and you should not have waited this long. But a lot of people don't do that because they don't take the stop loss. In my previous video, I've explained what stop loss is and how it helps. And if you guys are not aware of what these terms are, please do watch the first 2 episodes if this is the first time you're watching this particular video. So that is where taking a right exit matters the most. You have to keep understanding what's going on with the money that you've put into an investment. You can't put money in the stock markets and wait for things to happen on their own. You have to keep constantly understanding what's going on with the company where you've invested the money. And that too, in case of banks, there are a lot of indicators which tell the way the bank is going to perform and the way the bank is currently performing, what are its future prospects, and based on all that, you got to make a very sound decision. To close this out, I'm going to show you the CAGR of Lakshmi Vilas Bank, which is not at all interesting because you've lost all your money, excluding that small dividend that we received. And who cares for 6,000 rupees when you've lost all your 5 lakh rupees. So, and this is an example to understand that you should not be doing this kind of investments just randomly into any bank. So if you are happy with the return that an FD is generating, absolutely the choice is yours. But once again, I am saying that through this video, I am not propagating you to ditch FDs and go to the bank stocks. But there is a very, very attractive CAGR only if you make the right investment at the right time. please do consult a professional. Is the third time I'm telling this in this video, because many people think that if they know a thing or two about the P&L and balance sheet, they just know everything about the analysis, which is a very wrong notion. So there are a lot of people who day in and day out look at balance sheets, P&Ls, and in fact much more than that. By analyzing the ratios, they go deeply and then suggest you for what you're supposed to do. So make sure that our SEBI certified research analysts, and then you can also add your personal intuition to make such calls. Now to close out, I'm going to show you a very interesting chart that is coming up, which gives you a comparison of all of these. ICICI, HDFC and Kotak was a great thing to do because you have amazing CAGRs out there, 18, 16 and 16. Axis Bank was flat with the same amount of return that you got on the fixed deposit, but Yes Bank and LVB are a big no. So at the end of this video, I want you to realize that not every bank investment is the same, but yes, you can do a lot better than investing in an FD when you walk into the stock markets, provided you make the right study. To close out, a comparison on the CAGRs versus the CAGRs that the FD provided. FD giving you a stable 7% CAGR, while ICICI Bank giving you an 18% CAGR, is 2.5 times of what your FD gave. To that possibility where a complete wealth erosion in LVB. So which is why you hear every time in the advertisement that share market investments or mutual fund investments are subject to market risk. You got to do your reading very, very carefully. And as part of making you understand about various things, I've kick-started this initiative of the stock market series. So I hope you've enjoyed today's episode and have understood what to do with your money. Be a prudent investor. Don't be greedy. If you are very comfortable with the 7% CAGR on the FD, you can stick to that, which is what many elders do. But still, if you are young and you want to take a little bit of risk with a very attractive return, as I told you in the beginning, you can kind of explore into this space. Thank you so much for watching this video throughout. And if you have come till here, I have a couple of requests to make. That if you have liked this, do obviously like it and share it with a lot of people so that they can also take this perspective forward. And I would definitely like to mention a big thanks to all those who've been making those wonderful comments on the videos, which is actually encouraging. And some of them have even gone to say that the channel is so underrated, and that's a very nice thing to hear. So please do share it more and more if possible, because let it reach to people and also let them understand these different perspectives. I'm going to see you with one more video next Wednesday. Wait for it and I will catch you up there. Thank you. Bye bye.